Hey folks, it's Terry Gardner from C.J. Lawrence coming to you on Tuesday evening, the 6th of August, on the back of what has been a really wild ride in the equity markets in just the past 3 weeks or less. So I just thought I'd share some thoughts, a little unscripted tonight, and just reflect first off on what has happened in the last couple of weeks and how the market narrative and sentiment has changed so dramatically in just a couple of weeks. So if you reflect for a second back to the 13th of July, which was the date when the assassination attempt on former President Trump's life took place, that week following, there was kind of this groundswell of belief that Trump would win another term in office, and what that meant for the market based on perhaps more lower taxes and deregulation was somewhat perceived as bullish. Well, a couple of days later, the market hit a record high and we were kind of off to the races. That was less than 3 weeks ago. And then the Sunday after, President Biden announced that he was leaving the race and abdicating his position as the Democratic nominee, supporting Vice President Harris. And then the market kind of cooled that week. That was the week of the 21st of July, right? Then the following week, on July 25th, Thursday, the GDP results, the initial read on second quarter GDP was released and came in hot. If you remember, the estimate for quarter to quarter was for 1.9% growth, and the quarter to quarter came in at 2.8% growth. And on a year over year basis, the estimate was 2.9% growth estimate forecast, and it came in at 3.1%. So the narrative changed dramatically then, and it was all about rotating to cyclicals because the economy was stronger than everyone had anticipated. That was just 2 weeks ago. Then on July 29th, the Fed releases its statement, its policy statement, and hints that, more than a hint, that they would begin to lower interest rates in September. And so the market starts to shift then and think about a reducing and declining rate environment and where to be positioned for that. And the world shifts towards small caps. And it was all about, for 3 or 4 days, it was all about buying small caps because rates are going down. And then, just last week, Friday, August 2nd, non-farm payrolls and unemployment came out. And they were lower than expected, right? Unemployment was 4.3% versus an estimate of 4.1%, and non-farm payrolls came in well below expectations. And the narrative changed again, and all of a sudden now we were reintroducing the R word, recession. So small caps went out the window, and everything started to sell off because growth was slowing precipitously and we were heading towards recession. I mean, that's how the market has swung back and forth over the last couple of weeks. Cap that off on Monday with this yen carry trade phenomenon, which many people hadn't even heard of up until this week. So long story short, and I don't want to go into much detail on this, but investors were borrowing money in yen because the currency and interest rates were low, and taking that money and investing in U.S. equities. Okay, so when the Bank of Japan raised rates and the currency spiked, those investors were caught in a bad position and had to sell U.S. stocks to pay back the banks from which they borrowed, right? Long and short. There'll be some currency traders who will say my characterization is incorrect. That's a short summary. But the bottom line is that really added to the selling pressure that came on the back of the soft employment numbers and the higher than expected unemployment rate. So carrying this carry trade story forward, which I think is probably the crux of the challenge for the market, or has been over the last couple of days, we decided to take a look back at past situations where there were major currency fluctuations that upset global capital markets. And to be honest, and I like to go through these things, when this happened the past time, what the market did, there aren't that many parallels to the Japanese yen carry trade. And the reason is because this particular situation doesn't accompany a credit crisis or a credit issue or sovereign defaults, as a lot of previous currency crises have. They've all been accompanied by some type of a credit issue, a country default, an emerging market growing issue, etc. The only parallels that we could point to kind of came to or appeared in 2015, when in January of that year, the Swiss currency was depegged from the euro. The markets, for the most part, shrugged that off. Then in August of 2015, China changed the way they were setting the trading range for the renminbi. And that came as a surprise to global markets. China being the second largest economy in the world and a large consumer as well. That shook capital markets globally, and stocks here in the US traded off 11% on the back of that, only to recover that 11% in the following 4 weeks, right? So relatively short-lived downdraft. Same with December of 2015. The expectation was that Mario Draghi, who was head of the ECB at the time, would deliver a stimulus package, which he did not do. That surprise sent the euro higher and caused sell-off in European markets. That also found its way here to U.S. markets. You know, in December of 2015, the U.S. stock market, measured by the S&P 500, sold off 9%. Right, so there's two parallels where a currency issue and a rise in interest rates, a rise in a currency versus other trading partners, caused some ripple that put pressure on U.S. stocks. Looks like on average, stocks trade down about 9 or 10% on the back of those events. That's about where we are today. So is this carry trade for selling over? Tough to tell. Probably not. But I think the point is that this sell-off that we saw going into yesterday was probably driven more by that than a quote-unquote growth scare that was precipitated by the unemployment figures and the non-farm payroll results. So to kind of bolster that and take a look at growth and see what's happening, you know, the interesting thing is in the midst of all this, we're in earnings season. Companies are reporting second quarter results. About 80% of the S&P 500 has reported. And the nice thing is we can get a read from company managements as to what they're seeing. And this growth scare isn't being reflected by company managements, nor is it being reflected in earnings expectations for the rest of this year. If you had concerns from company managements who are seeing softening, and look, on the edges there is some softening. The consumer is starting to slow down in certain pockets, right? We can see that in the results of certain consumer goods companies. But we would see it a little more widespread if there was something underfoot that was challenging growth for the balance of 2024 and 2025. And we're not seeing it. In fact, I was looking at the earnings growth forecasts going out for the balance of this year and for next year to see if there was any change over the last couple of days or even the last couple of weeks. And honestly, what I'm seeing is that growth is actually coming in better than expected, and in some cases being ratcheted up rather than down. So the message from the research analysts that cover the 500 companies in the S&P 500 is, yeah, growth is slowing in some sectors, but not in others. For instance, in communication services, which contains companies like Meta and Alphabet and Disney and others, growth was expected for this quarter to be about 16%, and it's coming in around 23%, right? Same thing for technology, which everybody cares about. Growth was expected to come in at around 14.6, coming in at about 18% growth, right? And those numbers then will be reflected in the outlook for the calendar year 2024. Growth estimates are being ratcheted up, and the same for 2025. So we'll watch these numbers carefully. They'll be a good barometer as to whether or not the economy is slowing. We'll start to see earnings expectations either come in which they typically do a little bit during the year, but whether they come in meaningfully or not. We'll watch that and we'll see whether or not actually they get ratcheted up at all. But so far, earnings look pretty good, and that's a positive sign for the stock market. So a couple of thoughts I want to leave you with regard to this narrative about growth slowing. I don't think it's a surprise to the markets, to investors, that growth is coming in a bit, that inflation has been coming down, that unemployment probably will rise. So, and we've had a series of rate hikes that have taken us to the fastest rate hike growth in decades. So there should be some impact, obviously, from that. So we probably are heading into at least a lower growth scenario. Credit spreads aren't suggesting there's a recession imminent. Other economic metrics, the ISM services numbers that came out yesterday didn't suggest that there's a contraction ahead. In fact, that figure was still in expansionary territory. So I think it's fair to assume that we could be going into a slower growth situation, but not into a recessionary situation. So if that's the case, a couple of things to leave you with. First off, in a slow growth environment, strong companies get stronger, right? So there's this big question about large capitalization stocks. Well, they're growing fast. They've got huge balance sheets. So, I think those probably deserve a second look. Secondly, lower rates, which are coming, are good for stock valuations. So there's this concern about stocks are overvalued. Valuations could actually climb if rates come down. Thirdly, growth scarcity, right? As growth becomes scarce, as fewer and fewer companies are demonstrating double-digit earnings growth, those that do get rewarded. And then finally, as we mentioned in our last video talking about capital spending, growth CapEx is a competitive advantage. It widens the competitive moat between leaders and followers. So don't be concerned, don't be afraid of owning companies that are strategically investing in the future through higher levels of capital spending. So that's all I've got for you tonight. If you got any questions on any of this, give me a shout at 212-888-6403 or shoot me an email at tgardner@cjlawrence.com. I know you're admiring my new beach bag here, my CJ Lawrence beach bag over my shoulder. I'll be using that at the end of the week to head on out of here and take a couple of days off, so we'll catch up with everyone on the other side. Have a great night.